Hello and welcome to Hot Commodities. I'm Manisha Gupta and the top headlines on the show are: the Indian rupee slips in trade today, ends the day at 62.43 to the dollar on back of a choppy session on Dalal Street. The gold prices continue their upward march. The precious metal breaks above $1,270 per ounce after a weak U.S. jobs data on Friday raises questions over the state of the U.S. economic recovery. And the Brent crude prices ease back after hitting a 5-week highs above 109 a barrel on Monday as investors look ahead to more U.S. and Chinese economic data this week that could shed greater light on the demand outlook in the world's two largest oil consumers. Let's start with the gold prices, which are extended gains today, breaking above the $1,270 per ounce mark as well. Trading on your screens, 0.5% of a gain coming in on speculation that the Federal Reserve would slow the pace of its stimulus tapering after a weak U.S. jobs report raised questions over the state of economic recovery. Take a look at the crude oil prices as well, which did hit a 5-week highs earlier, but at this point in time there is a bit of a deep decline coming in for them as well. So we are down nearly 0.2% in case of the Brent. The NYMEX prices also are off the $100 barrel that we almost saw the commodity touching. The US and the Chinese economic data this week could shed further light on where the direction could be for both of these commodities. Let's get on board then. Vijay Bambani, who's CEO of VSPLindia.com. Also joining us is Sijin Cheng, who's commodities analyst at Barclays. And joining us in the studios is Ashok Mittal, who is CEO Emkay Global for their expert trade on commodities. Vijay, to you first, and let's start with the base metal space because that is an area that has been quite choppy. Even as the data has been on the weakening side, most of the international banks say that perhaps we could be bottoming out at these levels.
Good evening, Manisha. I sort of concur partially with this outlook. The only wild card, if you want to call it that, could be the Chinese outlook. In the absolute near term, it's the Chinese outlook which is clouding the outlook on base metals, barring which typically the first 4 or 5 months of a calendar year do tend to be positive for base metals, especially after January. As the weather starts to warm up and the northwest part of the hemisphere starts to see snow thaw, the factory production normally tends to ramp up. And once factories start to run again, inventories are piled up. And this is the time when manufacturers of industrial products tend to stock up their stockpiles of industrial metals, and therefore results in a 4 or 5 month spike upwards. Now, this year, I don't expect the spike to be as significant as you would have seen in any other year because of the Chinese factor here. But I would expect a buy on dips kind of an outlook in the coming 2 to 3 months, if not 4 months. And therefore, I would seek long opportunities on declines. Anytime I see prices decline by 2–2.5%, my tendencies across a broader outlook would be to buy the dips rather than short the rallies.
Ashok, hi, welcome to the show as well. How would you look at this sector? Because as Vijay is also pointing out, it perhaps is a better way to short these rallies. What side are you on?
Hi Manisha, I think when we talk about base metal back, we have to slightly change our idea or strategy and not really talk about base metal as a whole, because we think that within the base metal space also the movement will be different for different commodities based on their demand and supply. So broadly looking, since we see that industrial activities are much lesser and Chinese data we are not expecting will be positive, we in fact expect that they will continue to be under pressure. So that will put a lot of pressure on say copper prices. And on the other hand, I think zinc and lead are the commodities which are showing signs of strength, and we expect them to pick up in the next few weeks. And aluminium also is looking weak to us because we see a lot of fundamentals there. So net it will be very different for each commodity. So if we start with copper, we expect the Chinese data will not be good, and if the US data suggests that I think this is one event where you see that it has not grown well, but otherwise if the tapering continues, then the investment will not really happen, and hence there will be pressure on copper prices. They have been like close to say $7,000 on LME for quite a long time now. So we will expect that as of now there is pressure, so we can't see say near 7,000 or maybe slightly below that, but then that will be the time when you can actually look to buy. So as of now, I think the pressure will continue. If you look on MCX prices, they have not been able to cross a 460 level. So we think that 455, 456 is a good resistance level where you can actually go short. And then on the downside, we expect somewhere around say 440 or so to come on copper in the Indian markets. So similarly, if you, yeah.
Yeah, your point is well taken that individual fundamentals will really have to be taken into the count there. But let's also get in Sijan in the conversation. And Sijan, what's your sense really? Because the base metals have seen some opportunity buying coming in. How positive, how assured are you to go out and buy at this point?
Prices are probably going to be volatile in the short term because there are a lot of concerns about emerging markets and U.S. growth. So in the absence of macro data coming out of China, we think that a lot of growth headline data from the U.S. are going to drive prices. But we do think that for 2014, prices should see a modest recovery. So we recommend buying on the dips.
Sure. Sijan, I want to come to you with an individual commodity, and this one really is zinc, because we saw it rebound a bit from the longest losing streak in 25 years. What's your sense on the Chinese demand, and do you think that is something that could really support especially this one?
Chinese demand has been quite good, not only for zinc, but also for other industrial metals in the past year or so. And we think that that demand profile is going to continue this year. Investors also like zinc because it's one of the metals where mine production is actually going to be in shortage in about 1 or 2 years. So if you're looking at the price performance of zinc, it tends to outperform other metals in times of rallies. So we think that prices do have some upside. The main worry is whether there are unreported stocks somewhere in the world.
Fair point. Vijay, coming back to you, and what's your sense really coming in for the crude oil prices? Because in a jiffy, it went up to those 5-week highs. We almost saw $100 touching there. How would you want to trade at these current levels?
Manisha, keeping the view to MCX specific prices, 6,225 is a critical threshold which I would watch out for. Now, there are two ways to go about it. If you're looking for a buy opportunity, you need to see a clear breakout above the 6,255 levels before going on to a momentum-based buy decision. If you are looking for a higher risk trade setup wherein you want to test the waters, and by the way, I would want to do that, at close to 6,225 levels, I would initiate a very small sized short sell with a view to try and square up at 6,160 or maybe 6,185 kind of a band. And once that is done, I would see how the bulls are coming out and supporting the prices close to 6150, 6160 kind of levels. If they do come out and proactively support the prices, the probability of a breakout upwards then becomes a higher kind of a ratio for the bulls and bears. So at that point in time, I would not mind initiating fresh longs. But as we stand now, at 6,225, I don't really mind venturing out a very tiny amount of short sales.
Ashok, what's your sense in the energy sector? Because while we are looking at a 1% gain up in the crude oil prices, it's nearly 3% down for the natural gas prices. It really seems to have reversed there. How are you playing up your energy stage right now?
Within energy, I think, like we say, every time there is no correlation between crude oil prices and the natural gas prices. Crude oil, we think that the prices has been taking good support at the current level, so we are not really seeing prices falling below $95, $96 for NYMEX. So we expect that prices remain firm, and we do expect that we should see somewhere around $98, $99. So there is good scope of say around $2-3 upside from the current levels as well. So our idea on crude oil is that to play it from the long side and buy on dips. Talking about natural gas, it has been actually quite volatile. We saw it jumping a lot in the last few weeks and then suddenly taking some kind of correction. So I think still there is a scope of some correction on the downside, and we have really seen a lot of upside in natural gas happening. So in fact, natural gas we would recommend to remain on the sell side and play from the short side.
Ashok, also, how are you looking at the precious metal space? Because even as the Fed tapering has had 2 rounds, we haven't seen much decline coming in here. There is some risk aversion in the markets, and the gold and silver prices seem to be taking quite a bit of a benefit of that. So while we are making higher lows, do you still feel confident buying on these levels?
Manisha, in fact, we are not really very bullish on precious metal pack, whether gold or silver. We do expect that we are close to the resistance level. Say gold, we don't expect crossing $1,300 right now, because we are not seeing the demand coming in the physical market. We are not seeing SPDR holdings demand is increasing. We don't see anything happening in India in terms of giving relaxations in terms of imports. So, and China, which has become a major demand source, is not really not picking up in terms of demand from that side. So fundamentally, we don't see any reason that there is a lot of demand happening for say gold. Similarly, technically also, I think we are at a level where it will face a lot of resistance. So our idea is to sell on upticks and keep a stop loss above say $1,300. On the downside, we do expect somewhere around $1,220 to $1,240 levels to be seen. At the same time, if you look at what we see at about rupee, so we had for 1 year forecast we have given 59 to 64. So we have seen that it has not really been going above say 64 so fast, and again we are now back to somewhere between 62 63. So if rupee appreciates further, that will also put pressure on prices in the Indian market. So we are not really looking to buy gold and silver as of now.
Let's get in a view from Sajjan as well. What's your sense, Sajjan? Gold and silver prices making highs in the day today. Is it safe haven buying, or is it because of the weak US data? And what's your sense on the prices?
If you look at our price forecast, it's right around $1,200 for this year. So that implies prices does have some downside from current levels. For the time being, though, of course, in the first several months of the year, we're likely going to see some emerging concerns about U.S. data, and safe haven buying is going to be not far from the surface. But beyond that, though, if the Fed especially is committed to tapering, and if we do think that growth is going to improve, then we do not recommend buying gold and silver, because they do not see much investor demand.
All right, so not too much of a bullishness there. With that, Sajjan and Ashok, we'll let you go. Thank you so much for joining us with your sense on all of those commodities. And with that, let's go for a short break. When we come back, we'll talk about the agro space and strategies therein.